Get started shortly. We're gonna start with our stock pitch series. I know many of you are here for this. Our presenters are all longtime SumZero members. They've got, I think, significant track records of posting great research on the platform. Our first presenter is Scott Miller from Greenhaven. Again, he's been on SumZero for a long time. Has written some really great things over time. So Scott, come on out.
Okay, hey, nice to be here. As you said, I'm a longtime member. Hope to give a little bit back to the community. Gotten a lot out of it. Hope to get a little back in the next 10 minutes. We have a quick disclaimer. Do your own work. Greenhaven Road. Been in business about 15 years. We have about 150 limited partners spread across 6 continents. We're concentrated. We tend to own about 15 companies. Long term, we have a multi-year time horizon. We tend to invest in smaller companies. We have one company in the S&P 500 right now, sort of primarily outside. We are within our portfolio. We have a number of different types of bets that are expressed. One setup that we like, which is more in the special situations camp, would be companies that are going from complex to simple, usually through divestiture, but where it kind of looks like a mess, but there's kind of a core, really attractive business in there, and as it simplifies, we generally can get some multiple expansion. And we also like businesses where the historical GAAP financials may not really be reflective of future earnings power. There could be all sorts of reasons for that, but that setup of complex to simple and historical GAAP financials, making it so a company doesn't screen well, are interesting to us. Company I'm going to present today, sub $500 million company, kind of on the right side. We're talking our own book. We're a large shareholder of it. I care about this company, and so factor that into account. Also, I'd say Legion, who's above us on the cap table, has been an activist, and they've played a role in the evolution of the company. And so, I talked about complex to simple. The business, the name is LifeCore. It was complex. It had agriculture, food technology, food processing, consumer goods, and then with sort of a seemingly lack of industrial logic, they had a drug manufacturing business in there. And so the general idea, if there was one, was that you had kind of all this crop risk that you were taking on the agricultural side, and crop size, crop price would wildly swing the financials, and you'd put in a more stable drug manufacturing business in there. I don't think it was a good idea. It didn't really work. It had been called Landec at the time, so we're now down to LifeCore, which is a fully integrated CDMO doing fill finish. It has approximately 450 employees, and the important thing is that it's located in the United States. So back to the idea of the historical financials not being reflective of the future. There were 2 things that happened. One was last year, Alcon, which is our largest customer, went through a destocking. And so, revenues were down. It's a one-time event. Alcon was just reducing inventory, so they were producing less. And then the other piece that's not reflected in the GAAP financials is they brought online a 5-head filler. So it dramatically increased capacity for LifeCore. And so I think an investment thesis should really kind of be able to boil down to one sentence. And so this is it. If Paul Joseph and team can sell excess capacity, the share price can 3x. So that's by Scott Miller in May 2025. So the math to a 3x is pretty simple. Again, because they have all this excess capacity, you can more than 2x, closer to 3x revenues without additional spend really. And margins should improve as you are utilizing capacity, right? There's operating leverage there. So current margins are roughly 15%. You have industry peers that are 30, and you can kind of get 25 to 30. You get paid there, and then also on multiple. So the peers have been taken out at kind of twice the multiple of where LifeCore is right now. So we're not banking on multiple to get to our 3x, but you might get it. And so this slide just sort of demonstrates, it's a busy slide, it's from their investor deck, but the bottom two lines are really what you should pay attention to. In the darker blue, it talks about available capacity, and you can see it went from 20 million units to 45 million units, so that's the five-head filler coming on. And then capacity utilization, right, went from 50% utilization to 20% utilization. So we are using a fraction of the capacity. And so why might this happen? This is a picture from Liberation Day. We can argue about our country's trade policies, but I think if you watched Liberation Day and you were in charge of a pharmaceutical supply chain and were thinking that you weren't going to onshore any production, either sort of existing or future, you know, I think that would be an unusual conclusion to reach. And so there is this tailwind from onshoring that I think we'll see. And then there's also just in general CDMOs. Pharmaceuticals are outsourcing manufacturing, so CDMOs are growing roughly 8%, sort of in the fill-finish injectable space where Lifecore's playing, they're growing 10%. You know, half of new drugs that are being approved are for injectables, which is where they play. So you have this tailwind, just industry tailwind. You have trade tailwind, industry tailwind, and then, you know, at a product level, GLP-1s. Lifecore doesn't make any GLP-1s right now, but they can, and it's been capacity constrained, and so, you know, you may end up with a large GLP-1 deal, or they may continue to take up capacity elsewhere, which makes the selling of capacity easier. So, you know, those are kind of three components why I think that it may happen in terms of the sale. There's always a catch. There are really many catches, but the one here is it'll take time. So even if they announce a big new customer or a tech transfer, it'll take 18 to 24 months to show up in financials as it goes through the regulatory process. You know, we may get an executive order that would accelerate that, but there's really kind of nothing firm in the pipeline there. So it'll take time. And that's it. That's your road to a triple. It's not the VC panel before with their 5 and 10x or whatever it was, but in public markets for, you know, these are really stable businesses with stable customers and a bunch of tailwinds. So that's it.
We're going to do these in rapid fire. Scott, thanks so much for that pitch. So our next speaker is Nitin Sacheti. This guy was like user 30 or something on SumZero's, been on the site forever. We overlapped in college, so I can make fun of him a little bit. But anyway, come on up, Nitin. Great to see you.
And Divya didn't tell you we dated roommates in college, and that's how we got to know each other. So forward-looking statements, you know, not investment advice, do your own homework, or invest with me and we can do the work together. Pitching Cogent Communications. So I guess what I would say is, for us, we like to look for real corporate transformations, and you know, anytime we think there's a great owner-manager who's made a very large acquisition, we take a look, and that's the case with Cogent. Dave Schaefer, founder, CEO, he put the business together in the late 90s after the internet bubble burst, and he combined a bunch of distressed fiber assets that he turned into legacy Cogent. In May of 2023, he acquired the Sprint wireline business post Sprint T-Mobile merge. And so it's sort of the acquisition of this Sprint business that makes me really excited about Cogent here, because you effectively have sort of an AI secular case that you didn't have before in the legacy Cogent business. So what was legacy Cogent? So legacy Cogent was effectively fiber connected around the country, mostly in metro areas. And so, you know, the former CFO of the company told me that this is probably one of the hardest to recreate fiber assets, just because of these metro rings that Dave put together, you know, over the last, 20 plus years. And so that is fiber that connected to corporate office buildings and fiber that connected to data centers. centers. And so the value of the data center connected fiber is that it offers service to what are called net-centric customers, so Netflix, cable companies that need connectivity to data centers. And then in terms of the corporate business, that's effectively connections to office buildings, offering, very high-speed internet access and owning basically one of the few owners of sort of the fiber and the rise, in sort of the risers in the corporate office buildings. So corporate business, very, very good business, stable, free cash flow generation, kind of like clockwork, low to mid single digit revenue growth, very good operating leverage. Net-centric business, slightly more competitive, but this uses all the same infrastructure, and so very high incremental margins on the business. And so in terms of the Sprint business, what is that now? So Sprint, this Sprint fiber business, after the T-Mobile merger, T-Mobile didn't need two sets of sort of fiber that connected all of the towers to do all of the backhaul. And so this Sprint business was burning about $350 million a year. It was really just long-haul fiber that was connected to towers, and nobody really wanted that business. So, but Dave stepped in and he bought it, for $1. And part of the reason T-Mobile was willing to sell it for that was because this was, again, burning a lot of cash. And in the agreements with the Department of Justice, they couldn't fire a bunch of employees here to cut costs down. But Dave was able to buy this because these two businesses fit together like a glove, and a well-fitting glove, and in the sense that Dave had all of this legacy Cogent data center connected fiber, and then Sprint had the long-haul fiber. And so when you combine these two businesses, the idea here is that you have, they're selling wavelengths. And so wavelengths are basically the only growing business in telecom right now. So I'm sure a lot of people here are on Torsten's, Apollo's daily Spark email. So he talked about this morning how data centers are basically 1% of sort of US GDP growth. And so the point being that there's a lot of new data centers being built, as we all know, and Cogent has basically is offering this waves business that's point-to-point connectivity for data centers. And so what exactly is that? You're a hyperscaler. You have two data centers. Let's say one is in an area that's ripe with power and with water and cooling for GPU clusters, but then you have all of your data in a different data center and you want to do training and inference. The way to do that is to kind of connect these two data centers with this point-to-point private connectivity, because that offers the best latency versus public internet. And so by combining these two businesses, legacy Cogent and Sprint, Cogent is basically able to offer this point-to-point connectivity with very high incremental margins, again, using all the same infrastructure they already have. And the secret sauce here really is, one, the rings, because these rings that Cogent had was already connected to, a number of data centers, and they've increased that to about 850 to 900 data centers now. And then the other piece of the pie that's, kind of creates the real secret sauce and barrier to entry is the fact that Sprint's fiber runs on different conduits than the two other companies that offer waves, Zayo and Lumen. And so the value, again, to an Amazon is if you already have service between data centers with Zayo or Lumen, you want redundancy, right? In case that fiber gets cut, you're going to go to Cogent now because that original Sprint fiber, again, was in different conduits. So for $25,000 a year, you can, add a second sort of redundancy to your data center, and that's a very cheap insurance policy in case that single set of fiber goes down and you can't access that data center anymore. So that's really the value here. That's some of the secret sauce. And so why does this opportunity exist? Why is the stock interesting here, and why is it going to go up? So, a few reasons why the opportunity exists. One, these waves these fiber rings that Cogent had, they were connected to data centers, and they were also connected to office buildings. all in the same ring, right, when they had the legacy Cogent business. So Cogent has had to work to separate these rings out because the way to offer, again, that point-to-point connectivity is by having sort of a separate ring inside cities. And so that took time. So it's taken the last 2 years, and they've really only started selling waves as of Q1. And the interesting thing about, the fact that they've started selling waves in Q1 is that, is that a lot of the sales started in March, and so people aren't seeing the revenue growth, even though the net ad, gross ad numbers look really good. Two, there were cap structure balance sheet concerns. These are complicated financials. They're pruning a lot of the legacy Sprint business that was low margin, and so the headline revenue growth looks negative right now till Q3 when that ends, and then we start to see positive revenue growth. Three, they were spending CapEx, and that CapEx is now going to come down. And four, what's interesting here is that there are hidden assets that I'll get into in a second. And then the last issue here is that this is, a levered telecom. There aren't very many, levered telecoms that have worked in the last, 5-7 years. When you think about Lumen, Altice, Frontier, Consolidated Communications, just to name a few. And so people are really taking a wait-and-see approach here, especially on the sell side, to make sure this waves business really works. Hidden assets. There were some telecom switching facilities in the Sprint deal that Cogent got. And, Dave, again, very, very smart guy. He's, created multiple billion-dollar businesses. He saw that he could turn some of these switching facilities into data centers. So this is separate from the data centers connected to the fiber. This is owned data centers. And so he spent the CapEx dollars to convert these telecom switching facilities into data centers because they have dedicated power, and they're in the process of being sold right now. I think that sale happens in Q2 or Q3. And so, in the slide here, you basically have, the asset sales, right? And so you have essentially net debt, and then you have sort of $500 million or so in data center sales this year that happen. He also inherited a lot of IP addresses. So IP addresses are, the way internet-connected devices, talk to each other. So more internet-connected devices, but few sort of new IP addresses out there. And so they've appraised those IP addresses at something like $2 billion, and this is, again, on a $4.5 billion EV. And so they're in the process of securitizing some of those IP addresses and using the securitization proceeds to delever. And then all of this fiber that was acquired and brought together here, they don't need all of it. So they're going to sell, and again, this is a good $30 billion plus of invested capital. So they're going to sell some of that dark fiber to the hyperscalers. So you can see here that there's a massive delevering that's going to happen, as some of these asset sales happen over the next, year and a half, 2 years. Valuation modeling, again, legacy Cogent, Sprint, low single-digit revenue growth, operating leverage, mid-single-digit, EBITDA free cash flow growth, waves, $2,000 ARPUs, 20,000 customers by 2026, and then effectively the hidden assets that they'll sell. All of that gets you to, on a $50 stock, about $10 in free cash flow per share in 2028. And so where does all of that come from? It really comes from, the deleveraging. It comes from the declines in CapEx, and it comes from growth in waves. And so, like I told you, 2,500 customers on waves in, Q1 alone. 5,000 gets them $1 in free cash flow per share recurring. So, you can do the math on that and think that if they can get 2,500, 3,000 customers a quarter, it's not going to be long before they get to $10 in free cash flow per share. Catalysts sort of walk through data center sales, return to revenue growth, waves backlog climbing. People start to value this business on backlog. How do we play this? There's a dividend yield, so we own the stock, and then, we're not really playing it for the yield, so we're effectively taking our, proceeds from the dividend, and we're buying call options on top of, or leaps, I should say, on top of, the equity we own. That's the pitch. So again, when I look at $10 in free cash flow per share in a couple of years, I put a 15 times multiple on that. I can get to $150 in a couple of years from $50 today in a very stable, infrastructure business with recurring free cash flow.
We're on the theme here of 3x upside. All right. Next, we have Edward Robson, 2717 Partners. He's one of our newer members on SumZero. Edward's closed investments representing over $10 billion in enterprise value, focusing on software, fintech, and tech-enabled services. His prior experiences include leadership roles at Riverside and Cirrus Capital, with expertise spanning private equity strategies from growth to turnarounds. Please welcome Edward.
So thank you for having us. Big fan of the platform, and have always kind of enjoyed just reading a bunch of ideas on there. I actually only joined a couple years ago, and it's been a great source of ideas. So the business we're going to talk about today is a company called DHI Group. In my career in private equity, I started 15 years ago. I've looked at thousands of businesses. This is single-handedly the best business I've ever looked at in my entire career. And so we'll be telling you today about the value creation plan. We started off at the last slide. So this is our team. Nick, my partner's here with me. Our strategy is effectively, we focus on investing in high quality recurring revenue businesses that are trading below intrinsic value. And so how do we come to a perspective of intrinsic value? It's effectively what we believe private equity will pay to acquire an asset. So that provides us good downside protection with a lot of upside as well. For every business we invest in, we'll build an LBO. As we all know, models will tell you whatever you want to hear or see. And so that's only like one component of our underwriting process. And to oversimplify investing in technology and business services, we really just invest in bonds, right? These high customer renewal, high customer retention products that have a lot of ability to improve free cash flow conversion. And so we'll often partner with management teams on improving that free cash flow conversion, which will drive total shareholder return, as well as kind of driving the growth of the bond through strategic accretive M&A. So here are kind of the four archetypes that we focus on. Today we'll be talking about a transformer. So we're pitching a sum of the parts thesis, which probably all of us in the room have lost money on. But I think the difference is in a transformer is you have businesses that have these subsidiaries that are fast growing, mission critical, really enduring business models that over time, they end up representing a larger sum of the parts and a growing sum of the parts, which should drive a re-rate in how the stock's viewed. So we also like to think about variant perception, great buzzword. The market for this business has been hyper-focused on the primary segment, which is responsible for 75 to 80% of historical revenue. And also management historically did not break out segment level financials down to free cash flow and EBITDA. And so what our team did over a year ago was we went on LinkedIn, we reverse engineered the cost structure and very quickly validated this business had 40 to 45% free cash flow conversion, validated with management, and recently, I think there's also a reason of like, why now? Like, why is the stock something you should buy now? Earlier this month, management broke out the financials, highlighting the research that we've done, and also drove, I think, a 70% share price appreciation in less than 4 weeks. However, we still believe there's 3x upside. Let's just take a glance at the company. On the left-hand side of the page, you'll see DICE. DICE is what everyone is kind of focused on. It is a job marketplace for IT service professionals. We all heard about AI earlier. The impact that this could have on this business is to be determined. However, in order for you to believe and agree with our thesis, you don't really have to put any value at all on DICE. DICE's primary customer segment is really enterprise-level staffing businesses. And so you can very easily turn off, turn on the product. And while they present themselves as a SaaS company, it's not really software, it's a subscription though. Now to the fun part, Clearance Jobs. Clearance Jobs is a two-sided online career marketplace for DoD security professionals. I found out about the business from my stepfather, who was a former Marine and basically a contract agent. And he'd help place people with security clearances around the world. He told me it was the best business he's ever worked with, 10 out of 10 on the NPS score, and it's the only place you can go. So if we think about moats, right? You obviously have LinkedIn, Indeed, all these products that can compete with Dice. However, you can't post your security clearances on LinkedIn. So there's only one place to go, and that's clearance jobs. And as you'll see, while the revenue for Dice is 84 million, it is only 25% of free cash flow. And so the market is just waking up to the value of this asset, which is highly strategic and is a compounder. History of the company, it was a former General Atlantic portfolio company that was an aggregator or vertical marketplace for jobs. Since the CEO has joined Art Zeal, he has deconstructed the portfolio and effectively whittled it down to just the 2 remaining businesses. Investment highlights, really, we're just going to focus on clearance jobs. I can tell you that maybe there's the right time to buy trough multiple, trough cycle on Dice, but for our conservative underwriting, we really just focus on clearance jobs. So there's a lot on this slide. I'll take it bit by bit. So if you think about what a marketplace is with a moat, you look for the underlying North Star metrics, which are the KPIs that actually create value that reflect that moat. So as you can see in the top left, the company's gone from 7% of the total clearance population on the platform to 20% currently. In tandem with that, the average monthly users have gone up significantly as well. And if you overlay job inventory data on top of this, it's gone from 9,000 jobs to over 50,000 jobs over the same duration. And so if you think about a marketplace and a moat, you need the flywheel. And then how does it show itself up in the numbers? It's exactly on the top left. You see inventory going up, you see population growing up, you see active monthly users going up. Going to the right, looking at market share, they have 2.5 times relative market share versus their nearest competitor. However, if you look at it on a revenue basis, they have over 90% market share. It is the only place to go to post jobs. If you think about this business and reframe it, it's effectively a royalty or licensing business on defense spending regarding human capital, which has historically gone up to the right. Now, we can all talk about a monopoly, we can all show statistics, but how does it show up quantitatively in the numbers? If you look at the bottom left, you can see ARR go from 23.1 million 5 years ago to 53.5 million today. But also when you think about a moat in a business that has a lot of pricing leverage, you can see that in the numbers. It's gone from $15.6 thousand to $25.8 thousand most recently. That's 65% increase. And if you think about how can you push the pricing, your biggest lever the furthest, you really have to think about the value creation and value capture. And if you think about the cost of recruiting, the cost of placement, it's still really low. And they typically target HR departments within subs and contractors in government agencies. And at 25.8K, it's roughly 1 to 2 users per business. So there's also the ability to increase wallet share. Get hit on Dice, I mentioned it earlier, it's cyclical. You know, I can show you G2 and Capterra customer reviews that'll show you it's a great business. Unfortunately, it's just cyclical, as all these businesses are. So these are the financials that were just broken out earlier this month. They went back a year. And so why is this business the best business I've ever looked at? From Q1 2017 to Q4 2024, clearance jobs showed quarter-over-quarter growth for 31 consecutive quarters, with an average quarter-over-quarter growth rate of 4%. Now, this past quarter, they showed a decrease for the first time ever. It was a 3% drop. However, it was also the second biggest bookings quarter in company history. If you look at the bottom and see the adjusted EBITDA margins of 45% and free cash flow conversion of 40%. It's a rule of 50 company trading at 5.5 times free cash flow. So we talked about transformers in the beginning. How does it show itself up in terms of like risk-adjusted return? We're hyper-focused on downside protection. Well, as the share price is pulled back and Clearance jobs has continued to compound. You can see in the dark space the level of coverage. So here's our price target. We run LBOs and everything. An LBO will tell you whatever you want to hear. The LBO math works at 15 times EBITDA. It works at 12 times EBITDA. So conservatively speaking, we assume 12.5, and we ascribe very minimal value to DICE. And if you put those numbers into the model, it tells you it's $6 in a very conservative base case. So to summarize, we think clearance jobs is a compounder. It's continued to grow consecutively, quarter over quarter. It has a high free cash flow conversion. It is effectively a royalty on defense spending and human capital. Thank you.
All right, that's three X's in a row. All right, our next speaker is Eric DeLamarter from Half Moon Capital. Eric leads a fundamentally driven, research-intensive long-short strategy with a focus on small and mid-cap equities. His background includes private equity, investment banking, and equity research. He has an MBA from Columbia. Please welcome Eric.
Well, thank you to the SumZero and AlphaSense team for hosting us here today. As Divya mentioned, my name is Eric DeLamarter. I manage Half Moon Capital. We are a research-intensive, public equity-focused firm. We spend a lot of time and take a great deal of pride in the depth of our research in uncovering unique and original ideas. We don't often present those ideas, or at least active ideas in our portfolio, but given what we believe to be the most attractive risk-adjusted reward and timely situation we've come across in several years, thought an attractive time to do so here for you today. That opportunity is Primorsis Services, ticker PRIM. Primorsis is a $4 billion market cap, specialized engineering, procurement, design company focused on the energy, electricity, and utility sectors. They effectively are contracted by utilities to design, engineer, and build, as well as manage for ongoing purposes energy infrastructure across the United States. The business and the end markets in which it operates are benefiting from an acceleration in secular growth, and this has been driven by electrification modernization to support the energy transition, reshoring and reindustrialization, and that combined with the upgrade cycle and need to replace retiring assets, that being coal and legacy inefficient old natural gas plants. Along with that, to deliver that electricity to the end customer, they also build the transmission distribution lines. They're positioned in the most attractive markets, alongside the most attractive customers, and in the most attractive end markets. That being Texas and Florida, the Sun Belt. They're a top 3 position, and number 2, in fact, in most of their core markets, alongside tier 1 customers who are well capitalized, deeply integrated with those customers, in fact, in many instances have multi-decade long relationships. There's a high barrier to entry business. They derive a competitive advantage through their know-how in this complex project deployment, history of excellent execution, scale, and just overall performance track record. You're not going to hire an unproven entity to build a multi-$100 million asset. That simply hasn't happened. They also have a significant amount of recurring revenue associated with the business, that which they derive from the maintenance, repair, and ongoing service of assets which they have constructed for their customers over the useful life of that infrastructure. The investment thesis can be broken down to the following. The aforementioned secular tailwinds, which are just beginning that inflection acceleration. The vertical integrated nature of the business, which provides them a significant competitive advantage. Their market share in their core markets being 10 to 15%, much higher in certain areas. And it's kind of the crux of it is the underappreciated nature of the business transformation and the associated financial performance that has been underway. We believe there's significant upside to their 2025 estimates, and they're already tracking ahead of the original estimates, the 3-year plan that they laid out last year, just before entering even next year. The discount is substantial to the valuation. We think there's a highly asymmetric risk-reward opportunity here. We see 80% upside year-end numbers, and as you look into 2025, upwards of 140% upside, significant downside protection. They're tracking to be net cash by the 3rd or 4th quarter. That equates to a 5-to-1 risk-reward quotient. So what is the market missing here? The ongoing mix shift, I think, is the most essential. But within that, the fact that just mechanically the margins expand as the more attractive segments of the business grow within that pie. The revenue is also booked out through 2026. A substantial amount of the revenue is also MSA-related or recurring and long-term contracted in nature. They have limited exposure to IRA. Their customers are not financing projects predicated on subsidies, tax incentives, or federal grants. They also have limited exposure to the data center electrical needs, only peripherally and less than 5%. CEO was dismissed last month for non-business related matters, personal ones. They have a strong bench. They're in the process of filling that void. All the relationships are managed at the customer level, so we see that as limited interruption. So how do you get paid? What are the catalysts here? We think will be clarity on the CEO transition by the summer. I think in the meantime, there could be a potential for the CEO open it to strategic alternatives. There'll be a lot of attractive, or it's going to be a highly attractive asset to a lot of buyers. The Q2 earnings results, they by practice do not raise full year guidance at Q1. It's pretty clear they will do so at Q2 and throughout the year continue to beat and raise. There's an acceleration in the free cash flow conversion congruent with that. We think they may release their 3-year plan to help make it more transparent to the marketplace later this year, a new 3-year plan that is. In the meantime, we think there'll be some project announcements. Energy backlog will build as we enter the seasonal busy period for that type of activity. They have a non-core segment, heavy industrial and civil, which is basically building highways, which they think they could potentially sell. That is effectively on the market at the right price, they'll sell it. Meanwhile, I think they'll also accelerate their share repurchase program given the strength of the balance sheet. The business transformation. I think the market, this is something they're really overlooking here. So over the last 4 years, Primorsis has recalibrated the portfolio away from that heavy civil and pipeline work to the higher end, higher growth areas of the market, which are higher margin. That was once 25% of the business. It is now only 10. To orient you here to the quadrant here in the upper right, that is now where they are focused. This is effectuated through the culling of legacy, unattractive margin businesses, transferring of assets, organic growth, as well as supplemented by some acquisitions. Then as you can see, the 2 tables to the right of those demonstrate what that is translated to from an earnings and margin standpoint. Up over a 50% increase in margins, doubling of returns on capital. We think they're in the middle innings of this, and there's a lot more to come. Secular tailwinds, briefly here. So utility scale solar is the building of hundreds of thousands of solar panel arrays to produce energy, electricity for hundreds of thousands of households or large-scale industrial use. They are the #1 operator in Texas, #2 nationally. What's interesting is 80% of new electricity that will be coming online in the United States this year will come from utility-scale solar. Over the next 5 years, almost all of the energy that we'll be building in this country to supply the grid is coming from utility-scale solar and natural gas-fired power plants. That is just what they do. And to deliver that load, there is going to be an expansion upgrade to the transmission distribution system, something that's been neglected. That is inflecting favorably. They're squarely right in the center of that. Just to illustrate this further, there's one example here that was released, only information by ERCOT. ERCOT's the electrical grid utility regulator for the state of Texas, just announced this 3 weeks ago. These are transmission infrastructure spending plans to electrify the western part of that state. Primorsis is the largest in that state at doing this. They're a logical beneficiary from this. None of this is expected or priced into their guidance. These numbers are in billions, incidentally. This is just one part of one region of their market in which they operate. I'm quite certain you are now some of the very few in the investment community that are even aware of this fact. The investment thesis is quantitatively can be broken down to significant upside to the current estimates, that of consensus and guidance. As I said, they're tracking ahead of those 2026 targets already. The highly discounted valuation, the chart we have laid out here is simply just trying to show historically where the forward multiple has been over time. If you take that where it was earlier this year, ascribe next year's numbers, you're looking at over 100% upside. These are our financial estimates. The kind of area I'd like to align you to is the far right, being the variance from the consensus and guidance and that of ours. While we think there's upside to the top line, the real leverage comes from the mix shift and what mechanically that translates to in terms of the margins and ultimately the earnings and free cash flow. We're at $5, which is about 25% higher in this year. That's significantly above where the street and I think anyone is anticipating. The discount is pretty stark. The closest comparables are mass tech and quanta names you may be familiar with. On some metrics, Primorsis actually has more attractive unit economics, but despite that, the margin, these are just capital IQ consensus numbers, not our own, it's trading at half the multiple. So a breakdown of what scenarios we hear. If you really beat it up, the red there is the downside. That's like straining every upside and performance metric. You only get about 30% downside. We think by year end they'll get to $80. We'll have 80% upside. That's predicated on hitting that $5 earnings and just a slight margin expansion. Still a significant discount to peers. Then if you look out into next year on the cash flow metrics alone and start ascribing higher multiples, you're looking at multiples of your capital under certain bull case scenarios. Thank you for your time. Appreciate it.
All right, we're going to wrap up our stock pitches with Raj Shah from Stoke Point Capital. Raj has a strong background in tech-focused investing with prior roles at Stillwater Investment Management, Light Street, and Highline Capital. He's a graduate of the McIntyre School of Commerce at UVA. Raj, the mic is yours.
All right, it's 3 o'clock. You have an hour to call your stockbrokers. People still do that. All right, well, thank you for taking the time here. As Divya said, my name is Raj Shah. I'll give you a quick disclaimers there to pay attention to. And then just 2 seconds on who I am, why I'm talking to you, and a little bit about Stoke Point. I co-run Stoke Point out of Palo Alto. We've been in business since 2018. We have a very specific framework for how we find ideas. It's a little bit differentiated or weird. You can see it at that triangle. It's the conjoined triangles of success for people who don't know what those are. It's a joke if you like Silicon Valley. There's many types of change situations out there, and that tends to be what we focus on and find out there. In the last couple of years, we've focused specifically on new listings, de-SPACs, broken IPOs, things like that. But we always tend to come back to transformative acquisitions, which is what brings us to today's pitch, LuxExperience. LuxExperience is the merger of two of the largest fashion e-commerce platforms in the world that is now forming the, of course, largest global fashion platform in the world. This is a truly transformative deal with MyTheresa, the legacy MyTheresa, acquiring YOOX Net-a-Porter assets from Richemont. Now, going forward, we'll call them YNAP, which effectively triples the size of this business. What's more, and what's really interesting about this deal, is that Richemont effectively paid MyTheresa, which is now LuxExperience, effectively paid them $550 million to take on these assets and run them for them. I'll get a little bit more into that later. So you have a new business, LuxExperience, which is going to be 3 separate segments. The biggest full-price commerce sites at MyTheresa, Net-a-Porter, and Mr. Porter, and a pair of off-price businesses, think discount, discounted last season's fashions with LUXE and a business called the Outnet. And finally, I know what you're thinking. You're all staring at me, a fashionable, handsome guy pitching a luxury platform. It's fairly obvious. But actually, that's not why we found this deal. If you must know, these pants are off Instagram from an up-and-coming brand, and this shirt is moisture-wicking, so I'm clearly not a fashion investor, but I do like deals, and I like them before other people have found them. So if you like special situations and change events, this has a lot of elements to it. This is not just transformative M&A. Also, bonus points if you get the Stefan reference there. And if you like me and you spend a lot of time on the internet, there'll be some other memes in here too. So let's start with the most important point here on LuxExperience and why we think it's interesting. We think the stock is at least a double in the next 2 years. And we also think LuxExperience shareholders are getting a steal. So why is that? I mentioned before that Richemont is effectively selling or paying YNAP, or effectively selling those assets to Mytheresa, what is now LuxExperience, plus contributing 550 million euros of cash and access to a 100 million euro revolver, all in exchange for a 33% stake in the business. So if you step back and just think about that for a second, sorry, I should have gone forward there. They're effectively paying $13 a share, setting aside the assets they're contributing, which is 40% above where the stock is today. LuxExperience is trading right now for about $9 a share. That completely ignores these assets that they're giving to them, and it's not often you see someone paying somebody else to take assets off their hands and run them better for them and get some upside exposure to the deal. Speaking of the deal, there is no deal risk anymore. It just closed a couple weeks ago. But interestingly, that's not in any reported numbers yet. So if you look up the company on AlphaSense or Bloomberg or CapIQ, wherever you get your information, the latest numbers are through March. So you won't see the $5, roughly $5 a share of cash on a $9 stock that's now sitting there as of today. So at this point, you'd be right to ask, why would Richemont possibly structure a deal with Mytheresa this way? The reality is Richemont didn't have a lot of options. The headlines you see over to the right on this slide are real headlines. Richemont, for those of you who don't know, is a jewelry and accessory-focused business. They own Cartier, IWC, Montblanc, brands like that. They came to own e-commerce businesses over the course of the last decade through some pretty aggressive empire building. They invested hundreds of millions of dollars into these businesses and burned a lot of cash doing so, trying to run them all off of the same IT platform for a set of businesses that are not all the same. As is often the activist playbook, activists came in and compelled the company to sell these assets and focus on the core business. During that process, Richemont found Farfetch, who was also in its own state of perpetual empire building. And if there was ever a business that was run more poorly than the YNAP assets at Richemont, it was Farfetch, whose founder was lighting cash on fire, buying whatever he could under the sun. As it happened, during the course of that deal negotiation and after it was announced, Farfetch's equity went to zero in 2022. And so once Farfetch went away, Richemont was back at the drawing board and had to find a new home. Enter Mytheresa, the primary competitor to these YNAP assets, but also a natural home with an already upgraded IT tech stack for full-price luxury goods online. Thought of another way, if this is a children's story, Farfetch was the hare and Mytheresa is the tortoise. So now Richemont gets to own upside in LuxExperience, so they had to buy into it at a higher price than you would buy it today, and can own a third of that business going forward. So here's what the industry looks like now. You now have LuxExperience becoming the single largest in the world while competitors are shrinking or exiting the market entirely. What's interesting about this chart is if you look at bars number 2 and 3, those are US-based brick and mortar retailers. So if you were to reframe this chart, which I was too lazy to do, and look at just Europe, the relative size of the bar for LuxExperience would be significantly higher. There are no large competitors in Europe anymore. Matches Fashion, which is there, went out of business last year, and we just talked about Farfetch, which was fire sold effectively to a Korean internet company after burning through a lot of capital. As a reference point, too, for what that means for the industry, Kering, which owns brands like Gucci, YSL, Bottega Veneta, pulled all of its inventory off Farfetch. So in a lot of ways, LuxExperience is the only game in town. If you think about it from a US perspective, Lux would be smaller on a relative basis, still at the left end, or the left end of the chart, but the US has actually, over the last couple quarters, been the fastest growing segment for that business. And finally, I'd note, if you look towards the bottom of that slide, that these are very complementary assets. Merging MyTeresa and LUXE Net-a-Porter are highly complementary, given that there's not a lot of overlap in both their customers or the brands that they carry. Some of you may remember, if you sat through a lot of stock pitches or looked at a lot of write-ups, a few years ago, a number of funds were pitching Farfetch, showing slides that looked a lot like the one that's in front of you. Well, maybe not with the Zoolander meme, but the chart on the left. The numbers on this slide are right. E-commerce in luxury is woefully underpenetrated. There's only about 20% of those sales that take place online, so it's a lot less than other verticals. The mistake a lot of people made was riding the wrong horse, or the hare in the children's story example. And if you think about why this has been such an investment wasteland, there's really kind of one reason. One is that everybody in e-commerce over the last decade or so has tried to be Jeff Bezos. They've wanted to have quite a bit of breadth with not a lot of depth. And e-commerce has always been a business of scale, but that doesn't mean you have to have something for everyone. In fact, in luxury, serving the elite few but serving them well has been the way to do this. We all go to Amazon to buy things that we need. We pull it up on our phone, etc. But you don't go to Amazon for Amazon to tell you often what you need to buy. You don't go there to browse. It's different in luxury fashion, where you go for inspiration, and that ends up creating loyalty. When you think of MyTeresa, which is over on the left there, you should think about highly curated. When you think of Net-a-Porter, you should think about broader luxury, but still pretty curated. Both have high AOVs, but MyTeresa does a better job instilling loyalty from its customers who come back. One of the interesting things we found during our research was actually, of the cohorts that buy, MyTeresa will lose 80% of the customers after their first purchase. But what happens to those other 20%? They don't go away. They stay. They come back year after year after year. And in fact, 41% of sales at MyTeresa and 37% at LUXE Net-a-Porter come from just 4 to 5% of their customers. And that number has grown every year. Notice I've grayed out the off-price piece on this. And why is that? Well, it's a different business. It's discounted products sold to a different customer base with a much lower AOV. So who's going to run and integrate all of these businesses? Michael Klieger, who's the CEO of MyTeresa and now LuxExperience, has been running the business for over 10 years, and he knows a thing or two about cutting costs and being scrappy, because MyTeresa was a subsidiary of now bankrupt Neiman Marcus, where he's always had to operate with profit. Not only has he done this, he's done it while delighting customers. If you look at the chart on the right, that's NPS scores for those of you that are familiar. MyTeresa has an 86 NPS, which is on the charts. It's not quite off the charts, but it is very high for any brands, let alone those in internet or retail. Fun fact about this CEO, fun fact about him in the context of the tortoise and the hare, he's a 6'7" ex-consultant, so he's a very tall turtle, and he's been moving very fast. The deal's only closed a few weeks ago, as I mentioned, and they've already replaced the entire management team at Net-a-Porter. Oh, sorry, I didn't skip back there, but see that later. So the plan now, if we look at cutting costs and growing the business, is a number of numbers here. The main takeaway here is that, as I mentioned before, YNAP was operated on a singular tech stack, which is problematic because it was different businesses. The plan at MyTeresa is to operate all of the full-price businesses on one tech stack and the off-price businesses on another. Why? There's two reasons. They're different businesses, different buyers, different merchandising, and a different margin profile. And if the off-price piece does not work, it is a very natural and easy way to sell off or shut down those businesses if it doesn't work. For the full price business, as I mentioned, there's minimal overlap between the brands. And that means for customers, there's a lot of revenue synergies. And the IT infrastructure merger means there's a lot of opportunity for OpEx cutting. The primary risk here is really the business in the off-price side of things. So this is a slide from a presentation the management team gave 2 weeks ago. If you're interested at this point, I would highly recommend looking at this slide and engaging with the company at this. But effectively, at an aggregate level, it'll take a few years for the business to reach about 4 billion euros in top line, up from 3 billion today, and at 8% EBITDA margins, without any change to macro environment. Notably, as I mentioned, these targets imply that the loss-making side of the business, the off-price piece, can be brought to profit. Management's earned the right to try that, but in our underwriting of this and thinking about the stock and the upside, we're looking at it from actually two perspectives. We can look at it from the perspective of if off-price works and if off-price does not work, and it's not self-funding. As of today, LuxExperience has 60% of its market cap in cash, which provides it a great deal of cushion. But they're going to use the majority of that cash to do this integration. They'll still have a lot of cushion at the end of it. If you assume merely a 6% revenue CAGR from here over the next 3 years, and recall, Mytheresa has grown at a 17% CAGR over the last 5 years, and a 6% EBITDA margin versus the average 8% EBITDA margin, you'll be looking at over 200 million euros of EBITDA. And what's that worth? Well, conservatively, we think it's a double if you only use a 10 times EBITDA multiple on it. But you can see at the bottom of the chart here what peers are trading at, and it's very debatable whether the dominant luxury platform should trade at a discount to these other luxury retailers. And don't forget, Richemont was so convinced of this deal, they paid $13 a share after contributing assets into it, and the stock's sitting here at $9, and we think it's worth $20. Just one very last note here, which is not to forget about China. China is about 25% of the global luxury market, and across apparel, jewelry, and accessories. And spending in China has dropped 20% last year, and at best, it's estimated by Bain to be flat this year. So Lux hasn't factored in any growth in China or return to growth in its estimates. And the headline that you see on the slide there is from last week, so things have not quite gotten better yet. But if and when that returns to growth, it would add a significant amount of upside to the shares and to the market. That's it.
So we're going to take a little break now. Thanks to all the speakers. Our keynote is next at 4 o'clock, so we've got a little less than an hour. Y'all can mingle, and I would strongly encourage everyone to vote on their favorite pitch. There should be a place to do that outside. So see you guys in a little bit.